Hi everyone, I'm Mr. Llama here, and today we'll be talking about the debts of REITs. As we all know, businesses have two main sources of funding. The first source is actually capital injections of cash, be it from the shareholders or the owners of businesses. The other main source of funding is actually from debts, and it means that the REITs are actually borrowing money from banks or the general public. So we'll be focusing on a few main criteria that we look out in the REIT, like gearing and other key ratios. And in fact, that aspect of a REIT is what I look out for the most during this COVID crisis. Why? Is this because for retail REITs, we are observing less foot traffic to the shopping malls, and for industrial REITs, we can see that the trade shocks can lead to certain businesses, especially SMEs, being subjected to the economic shocks and have this higher chance of being bankrupt. As for hospitality REIT, we are seeing that the traveling and tourism sector is almost frozen during this COVID crisis. And for logistics, it actually depends, and in fact they are holding up quite well, at least for those logistics REITs that have good enough sponsor or good enough quality in terms of its property portfolio. And for office REITs, it's actually a little bit uncertain due to the rise of video conferencing and working from home, and all these risk to the REITs, right, actually lead to the REIT property value dropping. And once the property value drops, there is a chance that these REITs are unable to meet the statutory requirement of REITs having to maintain this gearing level at below 50% right now. And first up, I would like to share the most important factor of a REIT to me right now. And this is an example of the slides from the investor presentation of Far East Hospitality Trust. And I think that this is one hospitality REIT, right, that is in my portfolio, and it is one of the REIT that carries the highest level of risk. And you can say that this is one of my riskiest investments into REITs. So we are looking at this key quality over here, which is known as the highest portion of debt expiry in the next 5 years. And for almost all REITs, right, you can actually get this information from the investor presentation slides that they publish quarterly, or for now semi-annually, on their investor relations website. So why do I look out for this higher portion of debt expiry? This is because of the various risks to REITs that are uncovered due to COVID, and we are seeing that the rental payments are indeed threatened, especially in the hospitality and the retail REIT sectors. So for example, for this Far East Hospitality REIT, we can see that they have to pay up $23 million in 2020, and they have this impending debt that is going to be mature in 2021, and this is $225 million. And in fact, this is a huge amount as compared to its net income, which I'm going to explain later on. So what happens in 2021 is that they either have to refinance this $225 million debt, or they have to issue more rights or shares to pay off this debt over here. Otherwise, they do have to sell properties. And all these three actions, right, okay, the best one is actually the first one, where they manage to refinance the debt and move the maturity down the line over here, okay, down to the future periods. If they are not able to refinance debt, or the property qualities or the traveling sector is really in such a dire state that no banks want to refinance their debt, then they have to issue rights or sell properties, which can be destructive to the shareholders, or this also can lead to dilution to existing shareholders. This is what we do not want to see, as it will lead to great losses in your REIT portfolio. So now over here, we're actually digging more into the performance of Far East Hospitality REIT, and from FY 2019 results, you can see that 58% of the rent is actually fixed. So if let's say during COVID, there is entirely no business for this FIRE's Hospitality REIT for the year of FY 2020. Okay, you can see that they can only make this 58% of the rent from the properties, and provided that the tenants that rent these properties for this REIT do not go bankrupt. So as we noted, they have to pay out $225 million in 2021, and they can either use this revolving facility for the banks where they have access to $277 million, and they can also use this cash where as at the year end 2019 they have $5.8 million, which is not really helpful because it's only $6 million compared to 225. And in 2019 you see that the net income of this particular FIRE's Hospitality Trust is $104 million. So let's do a bit of assumption over here, and we can estimate that in 2020 they can collect about 58% of 104 million, which is about $60 million in terms of rental from the hotel properties they owned. So you see that $60 million plus the cash $6 million, okay, it's not going to help a lot in terms of paying off this $225 million of debt in 2021. This is why I say that this FIRE's Hospitality Trust is one of the riskiest investments I have made in my REIT portfolio right now. Now let me show you another REIT that I have within my portfolio, which is Mapletree Industrial REIT. Now this REIT has recently made news by entering the STI index and also buying more data centers within the REIT portfolio. So you can see that in 2020 to 2021, there is no impending debt maturities, and in FY 2021 and to 2022, you can see that they only have this 7% or only $100 million of debt is going to mature in the next 1 year. So to pay off these debts, right, okay, it is really quite affordable for Mapletree Industrial REIT. And I say this because the net income in 2019 for this REIT is $367 million. So we do a bit of comparison, like $100 million no isn't really a lot because they can easily pay off using the rent they receive from their tenants. And in fact, for the industrial REIT, Mapletree Industrial, we see that it is more COVID resilient as compared to FIRE's Hospitality, where it is a REIT that holds hotels. Okay, industrial properties are still running as compared to hotels, which is almost frozen in terms of business activities. So once again, I wish to reiterate that you should be looking at REITs, right, with less debt maturity in the next 1 to 2 years, because the REIT sector is going to be hit by this continuous COVID crisis for the next 1 to 2 years. So it's best to invest in a debt maturity profile that's similar to Mapletree Industrial, where you see like the next few years, right, they can easily manage paying off the debt in terms of their rental they collect. So even if rental falls a little bit, by 20%, it's going to affect them much, and there's a very low chance that Mapletree Industrial has to issue rights or shares to pay off the debts. And the next factor in terms of debt, we can look at the gearing ratio of REITs. So generally, I would encourage you to own REITs with gearing ratio of 35% and lower. And I know that I have actually breached this personal rule by investing to FIRE's Hospitality REIT because they have a gearing ratio of 39.5%, or what we call as aggregate leverage. However, I have my own reasons for investing to FIRE's Hospitality REIT, okay, and I wish to also gain exposure into hospitality sector, and this is the reason why I actually took on a higher level of risk and invested into FIRE's Hospitality. However, for you, I will not encourage you to do so. Okay, and for this gearing ratio, it's actually computed by taking the total amount of debt of the REIT divided by the total asset. And it's mandatory, as mentioned, for Singapore REITs to maintain a gearing ratio of below 50%. And right now, we are actually unsure whether MAS will lower it back to the previous 45% after this COVID crisis. And actually, I feel that let's hope that they maintain this 50% because it gives the REITs more room for growth or for capital usage. And the total debt and total asset can be retrieved from the annual report, and I'm going to show you how later on. So to calculate this total debt, please note that preferred shares or perpetual bonds are not considered debts. So it's really purely debts that they really borrow from financial institutions or banks itself. So let us take a moment to practice calculation of Escort Trust gearing ratio. So over here, I've actually taken snapshots from the annual report 2019 of Escort Trust. Okay, you can see over here we have this balance sheet, and let's look at the left side first. So for total debt, we actually have to take the loans that they take from banks, and these are found under the sections financial liabilities over here. So under non-current liabilities, we have these financial liabilities, okay, of 1.6 million, okay. And over here under current liabilities, we also have this current portion of the bank loans, which is 311,000. And we also have to include the deferred tax liabilities, which makes up to be 153,000. So we add up all these, and this will make up the total debt of this REIT. We then divide this total amount by the total assets, which is found at this section under total assets under the balance sheet of Escort Trust, and we compute the gearing ratio to be 33.61%. So let's do a quick check of our answer, 33.61%. From the 2019 year-end investor presentation, you can see that the gearing ratio that they compute as professionals is actually 33.6%. And yeah, this proves that our calculation as shown in the previous slide is actually correct. So over here, just a few more summary key points to note is that particularly on this annual property valuation. So whenever you visit any balance sheet of REITs, you'll notice that a bulk of the total assets of the REIT is actually made up of investment properties. So annually, the REITs will actually carry out this property valuation. Some of the REITs carry out property valuation every 31st December, and some of the REITs actually carry out this property valuation every 31st of March. So you can see that in the next 1 year, there's a chance that property values will drop due to this COVID crisis, especially retail or hospitality sector, if you ask me. And once the property valuation drops, you can see that the gearing ratio will actually increase, because remember that total debts remain the same. However, the total assets is going to decrease due to the property dropping in terms of value. I've also mentioned about avoiding REITs with gearing ratio above 35%. And in my whole portfolio, I can say that I have more than 8 REITs in my portfolio, and only one REIT has a gearing ratio of more than 35%. And in fact, I've allocated less in terms of monetary amount to Fires Hospitality Trust because it's really a high-risk investment. I still like to encourage you to avoid REITs with large impending debt maturities, and preferably within the next 5 years, they have less than 30% of the debt expiring in any 1 year. Okay, especially during this COVID crisis, rental is going to be affected, so it's best to avoid those REITs that have a large amount of debt burden in the next 5 years. And the debt aspect is not just about these two criteria. We also can look at the cost of debt of a particular REIT, and also look at the interest coverage ratio, where MAS is actually try to impose this regulatory requirement that REITs have to have at least 2.5 times in terms of interest coverage ratio. So in the next video, I'll cover these two other aspects of debt for REITs, and hopefully you'll tune in then also. In time to come, I'm going to make more videos regarding the advanced criteria and advanced methods in order to analyze whether a REIT is worth investing or not. So stay tuned. Once again, thank you for watching this LlamaFinance REIT series video. Please remember to like this video if you find this video useful and share this video with your friends who are interested in REITs investing. Also subscribe to LlamaFinance channel for more future REITs video.